It has been a rough few weeks for the Chinese economy. The country is facing an economic slowdown with sinking consumer confidence and growing concerns over its real estate market. So, what's next for the world's second largest economy? And what does it mean for you? Several experts weighed in recently on Yahoo Finance.
Now we're going to take a look at Chinese stocks. They're seeing some relief this morning after government officials announced cutting a tax on stock trading. Now the move attempting to restore confidence in the world's second largest equity market. But China's ongoing woes are still raising concerns. Foreign investors have already pulled billions of dollars out of China's stock markets, and the street remains skeptical on China's faltering economy. Investment banks Goldman Sachs and Morgan Stanley have cut their targets for Chinese equities. Let's bring back in Paul Grunwald, S&P Global Ratings Global Chief Economist, and Michelle Schneider, MarketGauge.com Chief Strategist. So, Paul, I want to start with you because a lot of people are wondering about some of the most exposed sectors and industries, U.S. industries, as they're keeping an eye on what's happening with China and this propping up that policymakers are trying to do. How would you connect those dots?
Yeah, well, the U.S. is basically, it's a closed economy. It doesn't depend too much on the rest of the world. But the China story is big, right? China's been the #1 driver of global growth for a couple of decades. It's basically an investment-led economy. We had a narrative over the last 6 months or so that China would have a consumer-led recovery, and we normally don't kind of use that phrase with China. So that spills over a little bit in terms of tourism and maybe luxury spending, et cetera. But if the investment part of the Chinese economy is soft, and some people put the property sector broadly defined as something like 1/3 of the Chinese economy. If that's going to slow, there's a lot of kind of spillovers in terms of mineral demand and other demand and capex goods demand and stuff like that. So I'm not sure the U.S. is hugely exposed. Some of the data I've looked at suggests countries like Germany might be more directly impacted by a China slowdown. But if the #1 driver of global growth downshifts, we're going to get slower global growth, slower global commodity demand. China's the biggest oil importer in the world and energy importer in the world. So that's definitely going to move the global macro needle.
And Michelle, to what extent is softness in China also kind of firing off bells and whistles in the U.S. markets or equities as you're seeing them in Market Gauge?
Well, what's interesting to me is this is really also, I think, another example of a lot of bad news. And then yet, if you look at the technicals, although we could all say that China has been also well underperforming the U.S., it's holding up very good, or I should say way better than one would anticipate. It's actually coming in higher today. So I think it's really kind of hard to know. Now, I do know that the U.S. is taking a very hardline stance, but there's a couple of things that I find interesting about China. One is we know that they take a very long-term view on things. They're not like we are basically influenced week to week, quarter to quarter, statistic by statistic. Yes, the real estate has been under pressure, and with Evergrande, from what I've heard from people, that's been more of a restructuring. It's a Chapter 15, not a Chapter 11. And that, even though they're having some issues here and still much longer in terms of coming out of the COVID situation, which I think is a factor, I wouldn't necessarily discount them. They're doing tremendous amount of buying. They bought $5 billion worth of NVIDIA chips for their AI. So, and BRICS, let's talk about BRICS. I mean, I think they're the #1 influencer right now. If there's going to be any traction with BRICS, which to me, the most insidious part, besides the obvious, is that there is this organization of countries that are trying to fight against the West. So I'm looking very cautiously at what unfolds there in terms of China. We actually shifted a lot of our interest into Vietnam because that has actually been doing better as a place where we're doing a lot more manufacturing since we're not actually working as much with China. But nonetheless, I wouldn't discount it just yet. And if that FXI can get back up over, say, 28, it's trading at around 27 right now, that would to me mean technically it's not as bad as people think.
And Paul, to Michelle's point, especially as we look at chips and some of these national security issues that have now become political issues, as both the US and China really want to secure their economic future based on a lot of this high tech. What position does that put some of the companies, some of these multinational companies that have exposure to China, especially as they do seek to perhaps turn towards an India or a Vietnam to keep their options open?
Yeah, well, I think that dynamics happening at both the country level and the firm level, right? So a lot of countries have exposure to China. A lot of firms have a lot of business in China. There's geopolitics between the big two, which is the US and China. We have China plus one strategy. So some of the production might be moving to a Vietnam or an India, or maybe even closer to home here in Mexico. So everyone needs to figure out how to kind of navigate this new world. I think we've got a set of security issues around high-end chips and maybe some of the strategic minerals that aren't going to go away, but there's still a lot of scope for the two countries to compete economically. I don't think we've kind of rested on the final model for that, but we have to find something that works. I wanted to come back to one point that Michelle brought up very quickly, which is the BRICS group. A lot of airtime has been sort of spent on this. I don't think there's any threat to the US dollar as the world's reserve currency or the US Treasury as the world's global store of wealth, but we do have a sizable chunk of countries that are trying to maybe develop an alternative system, but we really don't see a big risk to the top status of the US currency or the US government bonds anytime soon.
Just to follow on, how would we see that kind of as we were kind of framing out going into 2024, now that we're essentially kind of looking at where China and where some of these partnerships actually may have a more profound impact in 2024, which is an election year, as we had put on the table earlier. It sounds like one of the things that may swing the markets is what political candidates could be saying about China as well. Is there anything that you believe, Michelle, that could rattle the markets as we get into heavy campaigning and the international and foreign relations that are going to be coming about, at least in talks leading up to that point in time in November of next year?
Well, I certainly hope Paul is correct on the analysis in terms of BRICS, that most likely the influence, although growing, is not going to really do any damage to the dollar as the world's reserve currency. But when I was reading all the headlines last week, and clearly the dollar hasn't fallen apart. I mean, it's well off its highs, but it's still doing relatively well. What bothers me about this, and what I think in terms of policy could actually make this worse, is exactly that. Is that the U.S. right now is basically poo-pooing the whole idea of globalization and going more into the deglobalization, which, by the way, it's in and of itself is inflationary, but that it could potentially push the alliances of the BRICS country further into wanting to do damage. And let's face it, to me, the most effective damage you can do to the United States would be through its pocket, as opposed to talking nuclear or any of the other combative type of situations that we've seen in the past. This is a different type of potential. And I'm just putting it out there. I am not necessarily saying it's going to happen. And God knows I certainly don't hope it happens. But it is certainly something I don't necessarily would readily dismiss if we have too much hardline policy here in the U.S.
Yeah, in all of our own very U.S.-centric, biased opinions, we would hope that it does not happen here. Thank you so much, Michelle Snyder, MarketGauge.com chief strategist, and Paul Grunwald, who is the S&P Global Ratings global chief economist and weekend warrior on the bike. China stocks failed to hold on to most of their Monday gains as the latest effort to jumpstart the country's economy fell flat. Several U.S. sectors stand exposed to China's failure to relaunch. How hard will they be hit, and what will it take for the world's second largest economy to correct course? Joining me now with more, we've got Brian McCarthy, chief strategist and managing principal over at Macro Lens. Great to have you here with us this morning, Brian. First and foremost, why has it struggled? What is this sputtering kind of derivative of, from your perspective?
Well, obviously, China is beset by a lot of geopolitical cross currents and risks on that front. They're in a transition of their economic model. away from credit-fueled growth to something they hope to be more value-added, but is not going to involve any kind of market-based reform. And against that difficult backdrop, the biggest housing bubble we've probably ever seen has just blown up. So this is creating a massive drag on credit extension in the Chinese system. It's putting the system at great risk for debt deflation, and it's going to have grave ramifications for consumer confidence and the growth level in the Chinese economy.
And Brian, I think a lot of times when people look at the Chinese economy, they look back at that breakneck speed. China's in a very different sort of growth pattern right now, but we seem to be in this phase narrative-wise of either China's collapsing or China's taking over the world. What are some of the important nuances that investors should keep in mind when they look at China's growth and how it sort of trickles down to the US economy?
Sure. So I'm sort of in the camp that China might be collapsing, actually. So, this property bubble, we're talking, potentially trillions of dollars in systemic losses. So we've gone from this situation where there are things like you allude to. China's got demographic problems. China's been slowing consistently and steadily for a number of years. The investment-led growth model was basically, they had to invest more and more money in lower return infrastructure projects. And then they're dealing with this sort of budding trade war over the last few years with the US. So there were all kinds of structural problems that were weighing on Chinese growth. And I think the question now in the wake of the property bubble is this going to continue to be a gradual controlled slowdown? And I think that's sort of the market consensus, that Chinese growth might slow to 3%. Or something like that over the next 3 or 4 years. And in that scenario, the direct risks to the US are fairly limited. But there is another scenario in which that proves to be an optimistic case. And this bursting of the property bubble elicits a sharper, harder to control slowdown in the Chinese economy, where maybe their growth is negative next year, which I think is not an outrageous forecast. In that environment, you've probably got severe weakness on the RMB, which is then infecting other emerging market currencies. And as we saw in 2015, 2016, that kind of activity can generate financial market feedback on the West, which can have serious ramifications. So again, in the controlled slowdown, we're okay. But if it's worse than that, there will be volatility in U.S. markets.
Okay, and so just focusing in on what you were mentioning a moment ago, and perhaps what is the worst of the bear case scenario in a negative growth environment for China, where do you see that impacting some of the other U.S. companies even that have invested heavily into and have banked their own growth ambitions around success with the Chinese consumer and with the market more generally in China?
Yeah, I think we're going to find that a lot of Western multinationals have bad growth forecasts in terms of Chinese consumption. Chinese households are sitting on somewhere between 65 and 80 million empty apartments. That's about $10 trillion worth of real estate that's sitting there empty. And now we're seeing declines in Chinese real estate of, by some reports, 20 to 25%. This is going to get worse. So, you take a third of the value of the 10 trillion empty apartments, that's 3 trillion in wealth evaporating amongst Chinese consumers, particularly in the high wealth cohort. So pretty severe effects potentially for companies that sell luxury goods to Chinese consumers. But I think that the Chinese consumption story, again, just a lot of companies going to be stuck with bad forecasts there, because the Chinese consumer, I think, is going to remain under a lot of stress in the next few years.
And so, Brian, obviously very interconnected economies here. Which U.S. industries then would be the most exposed if there was suddenly a sharp negative downturn in China?
It's companies that do a lot of business in China. Like Starbucks has had good numbers because they have had a bit of a reopening boost to service sector activity in China. That has happened. It's just been swamped by other negative effects, mainly emanating from the property sector. But Nike, again, any consumer goods makers, luxury goods providers to China are just going to continue to see, I think, disappointing revenue numbers out of that market.
Especially when you have a nation of savers, any sort of economic downturn, everyone will sort of clutch the purse strings ever tighter. We do appreciate you joining us this morning, Brian McCarthy, Chief Strategist and Managing Principal at MacroLens. Thank you so much.
Thank you.
Well, speaking of China, confidence in that nation's economy is waning as the country struggles to bounce back from the pandemic-era slowdown. Falling property values, retail sales, a strained relationship with the West are all weighing on the world's second-largest economy amid a deflationary environment. Today, perhaps in an attempt to send an olive branch, the U.S. lifted restrictions on 27 Chinese companies and organizations ahead of Commerce Secretary Gina Raimondo's planned trip to Beijing this month. Our next guest testified before the U.S.-China Commission yesterday, speaking to China's troubled economy and its global expansion plans, including its influence through its sovereign wealth fund. Joining us now with some insight into this is Zoe Lou, who is Council on Foreign Relations International Fellow. Zoe, thank you so much for being here.
Thank you, Julie and Brett, for having me.
So I guess let's start very big picture. What should we make of the current troubles in China's economy? How severe are they? And thus far, it doesn't seem as though the PBOC or policymakers there are willing to really throw everything at it in terms of stimulus. Is that going to continue to be the case? I know a lot of questions in there, sorry.
Right. So let me just take a step back by explaining the current turmoil, how to interpret that, and then move on to talk about where the appetite is in terms of stimulus. I would say that actually a lot of the problems that we are observing today in the Chinese economy has been a systematic accumulation of problems that are embedded in the growth model. And I characterize China's growth model rather than export-driven or government investment-driven, but instead I come down where the money comes from. It's really about financial repression. The model has been built upon financial repression, and that literally means it is against or anti-household consumption. So now we are talking about the extending the drag of household consumption on the economy, which is literally why when economy numbers is not necessarily good, job numbers is not necessarily good, people start not to necessarily want to spend, but rather saving. And this also moves down to what extent the Chinese government is going to give stimulus checks, for example. I do not see the political appetite there. Perhaps right now the top concern is how to clean up the local government debt.
And so is there anything that would signal to us that there is a stark shift perhaps in that consumer sentiment or in that consumer propensity to spend, given that there has already been issues around or concerns around data transparency? Is there anything that we can look towards to spell out where that shift is coming from?
Right. Brad, that's a good point, because if we look at a consumer confidence index, it's not that the Chinese government stopped publishing it or stopped updating it since April. If we look at last April to the last time we updated it, during this 13-month horizon, only January to March, these 3 months, consumer confidence number was above 90. And for most of the time, it was even below 90. And that was unprecedented because when the Chinese economy was growing during the roaring double-digit growth period, consumer confidence index has always been above 100.
Wow. Okay.
When we look at what happens next for the Chinese economy, I mean, for years there had been predictions that it would overtake the economy of the U.S. in size. Is that still going to happen?
So that's that question. I wish I have a crystal ball there, but I'm increasingly suspicious in terms of to what extent China can surpass the U.S. economy. Because if we just look at a per capita number, obviously China has too many people, anything divided by 1.4 billion is going to be minimum. But I still see China's growth potential in the long run, but what really is constraining the Chinese growth potential comes from both economic fundamentals that is related to the financial repression growth model, and then the other aspect is geopolitics. And a lot of these really create deflationary pressure, both from domestic and from international. And the deflationary pressure right now, we say, probably, there is that argument to be made. The current deflationary pressure could potentially be transitory because in particular for the consumer price, it was because of a significant drop in pork price. Therefore, price overall at the aggregate level went down. But if you look at if the politics is right, meaning if President Xi Jinping stop measuring policy swings, if he took the initiative to warm up relationship or ease the relationship with the West, perhaps uncertainties and the risk would de-escalate. Therefore, Chinese household would not be thinking about what if there is a war and my individual economic security is going to be subject to military conflict, whether it is Taiwan or something else. So they might be incentivized to spend, or for that matter, international companies would continue to invest in China. Other than that, I would still think the cloud over the Chinese economy from geopolitics side is still going to be deflationary.
And so what is that? What is the state of international companies investing in China? Because if you listen to earnings calls from companies like Starbucks or like Apple, they'll continue to talk about how core of a region to their growth ambitions that Greater China is. And of course, that kind of looks across how they break out their regions, but more specifically, they speak about China. And so with that in mind, what is the state of the investment? Because they would say, yeah, this is key to our growth, but at the same time, there's something different at play from what you're spelling out here.
I mean, again, this comes down to the size of the market.
Sure.
And for a long period of time, 1.4 billion is a big market for any consumer-based company, whether it is Estee Lauder or Starbucks, it is a big market. And related to that, the taking a long position on China, there is also the aspect of, well, there is rising middle class, right? And they are increasingly willing to spend. But the problem right now is the middle income families, they are not necessarily incentivized to spend. And part of the reason is because income growth over the past 10 years have declined and at household level. And then on top of that, job prospect is also declined, coming from both state employers as well as multinationals. Unemployment number latest is about 21.4%, and now stop updating. If we compare China's youth unemployment number with OECD level, OECD is about 10%, and 21% is only narrowly characterizing urban dwelling youth aged between 16 and 24. Now you realize, well, at the aggregate level, perhaps youth unemployment is even higher. So from that perspective, I really think China, yes, it is a big market, but perhaps in the midterm, in the short run, at least now, as long as President Xi Jinping's policy does not change, probably the market outlook is not necessarily good. But longer term, probably still positive.
Today, President Xi Jinping is in South Africa,
Yes.
meeting with that nation and participating in a summit there. As we see these economic issues in China, will China's international influence in regions like Africa decrease?
Julie, that's an excellent point. And I think given China's domestic slowdown, and compounding that, tension with the West seems to be continue escalating, or at least is not abated. So in this broader context, domestic and international, I would think President Xi Jinping, in order to expand the market for Chinese companies and find a new growth engine, perhaps, and also on top of that, sustain China's comparative advantage in the clean energy transition. China would still want to have expanded interest in Africa and Latin America, and perhaps the Gulf Cooperation Council member countries. And the reason is there are three reasons. The first reason is really about the geopolitics, because the BRICS group, as well as the Shanghai Cooperation Organization group, these are China-led, non-Western, has nothing to do with the United States or the European Union for that matter. It's not just loose association or partnership, but there is a geopolitics argument to be made from two perspectives. The first part is hedging against sanction, and given what happens in Russia and all that Western collective sanction against Russia, in particular seizing foreign exchange reserves or frozen foreign exchange reserves, China actually has the largest foreign exchange reserve in the world, more than $3 trillion. So from that perspective, Xi Jinping would have all the incentive to build an alternative system that is not centered around the dollar, to diversify or hedge against the risk. And the perfect vehicle would be through BRICS and Shanghai Cooperation Organization. And then the second part of that is related to energy transition. If you look at the Shanghai Cooperation Organization, these are a group of countries that are major natural gas exporters. You have Russia, you have Central Asian countries, you also have Iran join. And now the interesting part is Saudi Arabia. Saudi Arabia is interested in joining not just the BRICS, but also Central Asia, the Shanghai Cooperation Organization. Now you realize, well, China seems to be playing a very important role in the energy market towards the transition. And natural gas is going to be a transitional fuel. And then finally really comes down to trade. Given that, right now China's trade number in July is double-digit percentage decline. And compounded with, related to that, U.S. import from China actually declined. So where is China going to export?
Right, yeah, exactly. So all of this combined showing it's a complex mosaic, I think, is my takeaway. Zoe, really fascinating stuff. Please come back and see us again. Zoe Lou is Council on Foreign Relations International Fellow. Thank you.
China's economy is in trouble, and that could have broader implications for the oil market. Crude prices hovering just around $80 a barrel as worry over the country struggling a recovery dims outlook for demand. Here with more is Yahoo Finance's Rick Newman. So, Rick, what does this mean for oil prices? Are they headed lower?
Hey, guys, I hope so. That could be the case. What's going on in China with the softening economy, the sort of collapse of the real estate market there. They've got all sorts of problems. China does not at all look like the economic superpower in the making that a lot of people have thought it was during the last 20 years. And every time I see that there are problems in the Chinese economy, what that means is China is such a big purchaser of oil that when the Chinese economy softens, that means China's oil purchases generally flatten out or even decline. That is actually happening now. And China is such a big player in the market that when their demand goes down, it's relief for everybody else who purchases oil. That is a pretty important story right now because we've seen oil prices and also gasoline prices here rising. We've got oil in the United States at around $80 a barrel. Gasoline prices are around $3.85 a gallon. I think when gasoline prices cross into $4 and there's a 4 at the beginning of that price, I think that freaks out drivers. That's a big problem for President Biden. If that were to happen, of course, the timing for him would be bad if we got $4 gas just as he's mounting his reelection campaign. So global oil markets are complex. There are a lot of factors. But when China stumbles and its economy slows down, that usually means we're going to get a break on oil and gasoline prices.
Rick, how long could that break potentially last here? We're talking about the pact, and you mentioned obviously could be a huge break for President Biden if we do see gas prices lower. We know that's such an important issue here for voters. But when we talk about maybe the longer term effects of that, any idea what that would look like?
I mean, there's a lot going on in global energy markets. With part of it is the Russia's invasion of Ukraine, which has basically reshaped global energy flows. We, of course, have the move to green energy here in the United States and elsewhere. I guess I'd break it down into three things if you're looking at, let's say, a 12-month outlook. First, China's economy is not likely to recover anytime soon. They have been through many slowdowns, and they've been able to stimulate their way out of almost all of them for the last 25 years. This one seems different. There really are underlying problems, way too much debt in the Chinese economy, and that seems like it's likely to weigh down the Chinese economy for some time, think years rather than months. So that's good for falling oil prices. You've also got OPEC and OPEC Plus, including Russia. It's part of that broader OPEC Plus. They're trying to cut back on their supplies because they want to keep prices up. We've talked a lot before about Saudi Arabia drilling a little bit less. Russia's probably removing some oil from the market. And then the third big factor, U.S. production. I mean, people think we don't drill that much oil in the United States anymore. We actually drill a ton of oil. And the United States is now the world's biggest oil producer, and it looks as if we are going to hit new record highs for oil production here in the United States. It's not shooting up, it's inching up, but what's happened here is as oil prices stay elevated, drillers look at the market and they say, okay, we can make good profits at these prices, $60, $70, $80 or even higher. So we're seeing an increase in U.S. production. So all of those things combined are hopefully favorable for fairly ample supply. We've seen tight energy supplies the last couple of years, but that could ease for all those reasons.
All right, well, we will see. Oil closing today just above $80 a barrel. Rick, thanks.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Well, stocks in China taking a hit today. Hong Kong's Hang Seng Index falling almost 2%. It's now officially in a bear market. This after China's central bank cut its one-year loan prime rate. This key indicator for most of China's household and corporate loans was trimmed by 1/10 of a percentage point in hopes of the country countering its growth slowdown. That was, though, a smaller decline than some were anticipating. China's central bank also shocked investors by leaving its 5-year loan rate, which is mainly used to price mortgages, unchanged. With China's property meltdown elevating its financial stresses, how much more can the country endure? Yahoo Finance's Rick Newman is here to weigh in. Rick, you've been looking at the tea leaves when it comes to China here. And a lot of investors in the U.S. have been focused on this issue. It doesn't look like that China is getting out the bazooka here when it comes to stimulus.
No, and some analysts say that it needs to get out the bazooka. So China's economy is kind of a mess right now. And I go back a couple of years, Julie, when there were many forecasts that China's economy would eventually eclipse the size of the U.S. economy, perhaps by 2035, 2030, perhaps even sooner. That does not seem like it's going to happen. That may never happen. There are real problems in China. So we talked last week about problems in the property sector, well known, but there's basically an ongoing property bust there that is now apparently bleeding into the financial sector in China. Some are calling it a possible Lehman Brothers moment in China. So the question here is, should we worry about this? And there's a new note out from Capital Economics this morning saying, the effect of China's economy on the global economy and on global financial markets is typically somewhat overstated. So this is reassuring. If you're a U.S. investor, it says the main concerns about that U.S. investors should have are American companies that have a lot of business in China, that do business there. And they singled out Apple and Tesla as two big U.S. names that do get a fair amount of their revenue from China. So some possible risks there. But it is not likely that this is going to bleed over into the global economy or the U.S. economy and cause some kind of contagion. Jared would remember this. Maybe you remember this, Julie. In 2015, there were problems in the Chinese economy that did affect U.S. markets for 6 or 9 months. And we had a real sell-off here because of worries in China. But that turned out to be a little bit misplaced. And I guess Capital Economics is saying that may be the case this time as well. Don't worry so much about problems in China if you are an American investor.
I was in high school in 2015, Rick. No, I'm just kidding. One other thing that has been talked about with regard to China is exporting deflation, right? The idea that there has been deflation in prices there, and because they are such a big exporter of goods to the U.S. and elsewhere, that might actually help the inflation situation. Given, the research that you've been looking at, how credible is that idea?
Well, China has been exporting deflation for decades. The question is, I think the question really is, can they still do that? So you'll see a lot of headlines about the U.S. decoupling from China. And what's actually happening there is the U.S. trade deficit with China, which drove former President Donald Trump bananas. He said it was way too high. That's the whole reason he put his tariffs on a bunch of, hundreds of billions of dollars worth of Chinese imports. That trade deficit is actually getting smaller. We are doing less trade with China, but it's not falling off a cliff. So most of the stuff you're going to buy on Amazon, toasters, smartwatches, stuff like that stuff is still going to be made in China. So China, to the extent it can export deflation, will still do it. That was interrupted during the pandemic because of all the things we know about. Shipping costs went up. It got harder to get stuff. So China was not exporting deflation, and I think they are getting back to that. It's just probably not going to be as pronounced as it was for 20 years, say, let's say leading up to 2020.
Yeah, it feels like there have been some structural shifts globally. Rick Newman, thank you so much. Appreciate it.
See you, Julie.
With the property crisis also came corporate concerns here in China. Lenovo, Tencent, and Xpeng all painted a difficult picture for China as a rocky economic backdrop led to slowing demand for some of the country's largest companies. Paul Christopher, head of global investment strategy over at Wells Fargo Investment Institute, joins us now. Paul, great to see you here this morning. Thanks for taking some time. Let's kind of look back at the week that was in China and what that really sets up for what's next to come on a few different fronts. And perhaps we can start with the action that perhaps might take the markets by storm here if there is continued surprising activity out of policymakers in China.
Well, the China story is a difficult one, and it's weighing on investors here in the U.S. right now. It's a familiar story. It's post-pandemic there, right? So if you go to China, you'll see long lines outside of popular restaurants, tourist spots as packed as ever, train and airline tickets harder to come by, the catering business doing really, really well. But what's suffering there is private business. Private business is just not really sure where things are going next. They're struggling to contain costs, to make money. They're struggling to survive rather than to expand. And then there are these problems with the property developers and the local governments that have borrowed so much money to transfer land or I guess transform land into property. So those are the big problems, and those are weighing on China. Trade from China to the U.S. is down as well. That's not helping. And so you're getting this little bit of deflation coming from China to the U.S., worries about debt there. And that weighs on investors here, just as interest rates look like they're set to go a little bit higher. So it's a kind of a typical hand-wringing sort of August where a lot of people are on vacation and some of the worries start to close in.
Yeah, this always does happen in August, doesn't it, Paul? I heard one commentator this morning compare China in the capital market sense to a minnow. In other words, it's an economic giant. A lot of U.S. companies have been relying on the country for a part of their revenue. But in terms of sort of financial markets contagion, perhaps not as much a concern. Can you sort of put all of this in context for us, how investors should be thinking about the China issue right now?
Well, it's an apt sort of image of a minnow. China, like many developing countries, has focused its rapid growth on a lot of bank lending, and it's government-directed bank lending. So the government tells the banks who gets the money, who gets the capital. They have a stock market, yeah, sure. A lot of that, though, that stock market is run by insiders. corporate executives. They're the ones who are doing a lot of the trading. Increasingly, international investors have come to that market, but it's a very up and down market, a very volatile market. So in terms of where private firms can get capital, it's difficult if you're not already on the government's list.
And so if we were to look back towards, anything that is similar to or analogous to what China is experiencing right now and try to paint a picture or a correlation, at least, between where other markets in the world, how they reacted back then, is there any historical correlation that we can point to?
Well, it's a little bit early for that, probably. But one thing that's I'll say in the corner of the eye for a lot of investors is whether or not China is following the path of Korea and Japan. Countries that after their respective wars in the 40s and then in the 50s developed very quickly, especially through the use of government-directed bank credit, so government-directed industrial policies. And inevitably, government-directed policies will get some things wrong. They'll put money where it shouldn't be in bad businesses, bad industries. And so the debt gets to be too high, and then there has to be a consolidation. The debt has to be written off. And so that's the concern with China's property market right now, is that there will be debts that the government can't handle. I don't think that's really the case, at least not yet. We've seen this with Evergrande before. I think the Chinese government can do what it needs to do to hold stability there, but they do have some consolidation that they need to do in the coming years if they're going to right the ship in terms of how they use capital and how they use debt in China.
So, Paul, we have seen some recent flows away from China, at least U.S. flows sort of away from China. Do you think that U.S. investors should stay away from investing in Chinese companies, A, and B, should they also be cautious of U.S. companies that rely heavily on China?
Well, it's difficult because of the lack of transparency in China, and now that Beijing and Washington are playing one-upsmanship in terms of restrictions on companies and restrictions on investment, it becomes even more difficult for U.S. investors, any foreign investor, to make an investment in China where he or she kind of has a good idea of what the playing field looks like and how the rules of the game are going to work in the coming years. Having said that, though, there's still a lot of U.S. companies in China. And so let's say there's a retired U.S. investor who wants to maybe play into Chinese growth going forward. It will be a growing economy going forward. And one of the ways we've been suggesting is through U.S. multinationals that still have business there. Some have pulled out, many are still there. So that would be a way to let the big U.S. multinational manage the exchange rate issues, manage the labor issues, manage the regulatory issues, which are becoming increasingly onerous. But we're underweight emerging markets right now, including China. That means we prefer to have our money here in the U.S. And to some extent in Europe and in Japan. So we wouldn't be going to China first. I just wouldn't like to rule it out completely.
What do you believe the consumer in China needs to feel in order for spending to really be reinvigorated?
Well, there's a couple of things. One is that property is extremely expensive. And in China, one has to put down a big down payment in order to get the property, the building started. And the property companies right now have a lot of debt. And so it's a very iffy proposition. You give someone a big down payment. Will that down payment turn into a house? An apartment, or will that company just go bust and take your money down with it? So that's one big problem that the Chinese have, the Chinese consumer has. Another big problem is, will the Chinese worker have a wage? Will the Chinese worker have a job? Unemployment, especially among the young, is very high in China right now. And there have been lots of people, small businesses too, that have lost their incomes, lost their livelihoods. And it's not exactly clear how soon they'll be able to reclaim those.
The trouble in China continues. New home prices in the world's second largest economy fell in July for the second month in a row, adding to concerns a growing property crisis will further slam a struggling economy. At the eye of the storm is troubled developer Country Garden, which missed bond payments this month. And now, according to Bloomberg, a large trust could also be approaching default. This morning, the People's Bank of China stepped in to inject the largest amount of short-term cash since February. Joining us now is Dennis Uncle Vic Meyer. Uncle Vic, Vic and Scott Partner. Dennis, thanks so much for joining us this morning. So first off, I guess from your perspective, how much worse could it get for China's economy?
Diane, I think it could get a lot worse. Let me just give you one statistic. 70% of the household wealth held by the normal Chinese people is in real estate. When real estate goes down, it just doesn't affect the markets. It affects everyone in China. So as one of your former guests has said, I have never been this concerned about Chinese economy in my life.
Are we witnessing the makings of a lost decade for China?
Well, if you go back to the mid-1980s, Japan was going to be number one. It was going to control the world. So between 1986 and 1992, it went through its bubble period. But it hit a situation pretty much like today, Brad. A lot of money was invested in real estate. Real estate prices went crazy. And then all of a sudden, there was a collapse because Japan then suffered from deflation. So their Nikkei, which was their stock market in 1992, which was about 30 or 32,000, dropped to 8,000. And really, I think it's probably only been within the last year when it's gone back up. Deflation in Japan looks a lot like you could see in China.
And then, Dennis, I want to ask you, just in terms of, so the real estate sector, the latest shoe to drop, if you will, there in China, what does China need to do? Do they then have to turn to households to stimulate their economy, or is there not enough there?
Good question, Diane. Two things. No, there is not enough there, in my opinion, for the Chinese to deal with it. The fact that they dealt with the 10 basis points and last week said to real estate companies, we're going to give you another year to pay off on your debts, it's not enough. I think it would take significant intervention by the Chinese at this point. It hasn't come. I guess yesterday, or Wednesday, but on Monday there was a meeting of the Politburo, which is the senior ruling group in China, and they looked at this situation. They said, we're going to work on this. We're going to deal with it. At this point, I think the Chinese leadership has done too little. Hopefully, it's not too late.
Dennis, friend of the show, Matt Maley from Miller Tabak, said in his morning note, we're getting very close to removing the word potential from the term potential contagion. Would love to get your perspective on that. And if so, and if that is to be true, then what other parts of the world, what other parts of the stock market even, when you think about U.S. companies and international companies that rely on China for some of their growth and additionally some of their partnerships to everything from manufacture to sell into the economy, how could that impact them further?
Brad, let me take that in two parts. First of all, the first people or the first countries to be hurt significantly will be those in Southeast Asia, because they not only sell a lot of stuff to China, but the Chinese have orders coming back and forth. I think that their markets will be hit first. As we know, the U.S. economy is fairly healthy today, but eventually a weak China exporting less and importing less from the U.S. is definitely going to affect the markets.
And Dennis, I want to ask you about that move that China made this week about the reverse of pulling back the curtain, kind of closing the curtain on that data on employment. What should we make of that? I mean, we know China is obviously not a democracy, so there is an opaque nature there in general. But how concerning is that, and are we concerned enough about that?
Diane, in the best of times, China has never been transparent. Mm-hmm. It's been a little bit more transparent recently, but I think what you're referring to is Chinese youth employment, which is under 25, I think is about 21 or 22% now, which is at an all-time high. When the Chinese saw that, that's the kind of news that I think the central government really doesn't want to have out there. So the semi-transparent China has become very opaque at this time. And that's really typical for the Chinese. Whenever you see, for example, during COVID, when the Chinese economy was dropping in 2021 and into 22, the quarterly estimates of the growth of what would come out in China weren't brought out by the government. And so they are not happy to have bad news out there. And I think this is a good example, Diane.
In a series of shocking moves that have been made by the government with regard to and response to the economic data that they are seeing, what is the next shoe to drop from your perspective?
The next shoe to drop is, I think, that their real estate market is going to get even worse. There's a Chinese trust company called Zhongju, if I said that correctly, But as a trust company, it's a shadow bank. Banks in China today pay you 1 or 1.5% if you deposit money in there. But these shadow banks, the trust companies as they're called, will pay you 6 or 7 or 8%. Zhongzhou announced yesterday or Monday or Tuesday, whatever day it was, that they were not going to be able to pay back their obligations to their folks. Zhongzhou is an example of a trust company that has 1 trillion yuan or renminbi money sitting there. So if you're an average Chinese person, you have a lot of your money invested with them, and then you see the real estate market dropping. It's really very serious. I do not see a quick end or a quick improvement to what we see, Brad.
Dennis, thanks so much for taking the time, providing some insight and perspective here this morning on a very large matter that everybody in the investment and economic community should be paying close attention to. Dennis Uncle Vic, who is the Meyer, Uncle Vic, and Scott partner. Thanks so much for the time.